What are ETFs? ETFs are an excellent way to diversify your investment portfolio. They should be strongly considered if you're an individual investor just getting started in the stock market. But first, you must understand what they are and the possible rewards and risks involved. So let's get you started. Despite the fact that exchange-traded funds, ETFs, have been available for more than 20 years, interest in them has only begun to grow recently. According to a report, the value of assets held in ETFs has surged more than tenfold to more than $5 trillion in the last 12 years. As the name implies, ETFs are a collection of securities that can be purchased or sold on a stock exchange through a brokerage firm. Like mutual funds, they employ a passive strategy for investing by tracking market indices. An ETF can be designed to track anything from a single commodity's price to a large and diverse collection of securities. ETFs typically track a specific index, sector, commodity, or other assets, but unlike mutual funds, they can be bought and sold on a stock exchange in the same way that a regular stock can. They are easy to set up and can be an excellent way for individual investors to make profits in a non-time-consuming process. ETFs are classified as either passive or actively managed, each with a distinct investment objective. Passive ETFs. Passive ETFs mirror the performance of a broader index. The index could be a diversified index or a more narrowly focused sector or trend. A diversified passive ETF replicates the performance of popular stock market benchmarks such as the S&P 500, Dow Jones Industrial Average, and MSCI World Indexes. Narrowly focused passive ETFs or niche passive ETFs are those that replicate subsets of major indexes such as the S&P 500 sector subsets or Russell 2000 tiny companies. They may provide investors with focused exposure to help them fine-tune their portfolio strategy. Active ETFs. Actively managed ETFs often do not track an index of securities but rather have portfolio managers make judgments about which assets to include in the portfolio. They allow managers to use their own discretion in selecting assets rather than being tied to a certain benchmark index. Active ETFs have the ability to exceed a market benchmark, but they also involve greater risk and higher costs. Examples of actively managed ETFs include stock ETFs, commodity ETFs, bond ETFs, international ETFs, sector ETFs, and currency ETFs. Next, let's look at the advantages of investing in ETFs. Most ETFs monitor an index with little tracking error and have low fees. Due to the minimal tracking error, an index tracking ETF is less likely to drastically underperform the index than to considerably outperform it. Another reason why ETFs are so popular among investors is because they typically provide more transparency by reporting their holdings daily. This gives you more information about the specifics of your assets and may alert you to potential hazards. You would also have access to a diversified portfolio by holding a variety of investments. You can own a stake in hundreds of equities or bonds by purchasing just one ETF. For instance, an international ETF, which holds stocks from several countries, might diversify your portfolio. Most importantly, the growth of ETFs has resulted in specialized funds that reach all corners of the financial markets. ETFs may allow you to invest based on market sectors such as energy, health, and technology. You can also invest based on geography or certain qualities, for example, dividend-paying stocks. Now to the downside of ETFs. Nothing is without its disadvantages, and as good as they sound, ETFs could have a number of downsides. Top of the list of downsides is liquidity. Because certain thinly traded ETFs have broad bid spreads, you may be buying at the high end of the spread and selling at the low end. There is also the issue of settlement dates. ETF sales are not settled for 2 days after the transaction. This means that as the seller, your proceeds from a sale are not technically available to reinvest for 2 days. Lastly, while ETFs normally track their underlying index with reasonable accuracy, some technological difficulties might cause variances. Now that you know what the benefits and risks are, how do you get started? First, you have to find an investing platform. Most platforms allow commission-free trading, which means you won't have to pay platform costs to purchase or sell ETFs. A commission-free purchase or sale, however, does not imply that the ETF provider would also provide access to their products free of charge. Platform services also differ in convenience, services, and product diversity. The second and most critical stage in ETF investing is research. Today's marketplaces provide a wide range of ETFs. One thing to keep in mind during the research process is that ETFs are not the same as individual instruments like equities or bonds. When investing in an ETF, you must consider the big picture, in terms of sector or industry. Finally, determine which trading strategy to employ. If you're new to the market, dollar cost averaging or spreading out your investment costs over time is a good trading strategy for you. Even if you've learned all these useful tips I just shared with you, you still don't know everything about finance. Believe it or not, you can find more information you need in this video here. Judging based on your goals and investment risk tolerance, do you think ETFs are a good way to build your financial portfolio? Comment below.